Students, but they had a problem with the actions taken.
He said the January 6th committee destroyed all of the evidence. No. He said he defeated ISIS in 1 month.
Somebody says, I want to be a person that has an impact on society. What would you recommend that somebody do to train themselves and to work their way up to be somebody that's impactful on society?
Well, I think the first thing you've got to believe in something that you really care about. Now, I've been fortunate that over the course of my career, I've come up with things that matter to me, and I've pursued them. The best advice I ever got was from Mike Bloomberg, and he said to me at one point, he said, show me somebody who's never lost, and I'll show you a loser. And I believe that if you believe in something, go after it, take risks. Obviously, they should be smart risks, but they should be around things that you really care about.
So you would see your legacy as being actually target ALS and helping to moderate the impact of ALS, if not cure it.
That's my final legacy. I'm proud of some of the other stuff that I've done as well. Transformation of New York after 9/11. I'm also incredibly proud of a lot of the companies we created at Sidewalk, but I feel like I've done a lot.
Upstate, and Bloomberg has the report under surveillance.
Oops, we did it again.
We have a strong economy, labor markets are tight. We have to question, can the economy stay this resilient?
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The jobs market is not deteriorating. How long can that story keep holding for the Special Reserve?
It's a source of strength. We can debate it all day.
The April Jobs Report, Friday on Bloomberg.
Welcome back. You're watching the China Show. President Xi Jinping is convening senior party officials in July. That's for a closed-door gathering. And that meeting is closely watched for any long-term policy signals. And the date for the so-called third plenum was announced after this week's Politburo meeting. Now, it's the first time that the plenum will be held in an off-schedule year in over 3 decades.
Yeah, we've talked to several people about, that at least confirming that meeting is actually quite significant given it's been delayed. So certainly that may signal we might be getting more news on the stimulus front and the like here. But what we also got from that statement, from that meeting, was everything about, monetary policy, maybe more of a push to fiscal policy, the flexible use of that interest rate and RRR. They also want to study policy to digest the housing stockpile. This is something that everyone was sort of talking about meeting about, was the government going to step in to buy up some of the stockpiles from these developers and what to do with it, right? But certainly that's certainly one thing we're watching out for as well. And of course, we're going to talk about the corporate debt side of things in China. S&P finding that the real estate sector has $34 billion worth of offshore bonds maturing this year. They've also conducted this long research about where we are when it comes to defaults in China. Let's bring in Charles Chang, MD and Greater China Country Lead for Corporates at S&P Global Ratings. Charles, it's good to have you. I just want to get your take, the fact that we're hearing maybe this new plan to fix the property market and the supply issues there. How significant is that?
I think it's significant to the extent that the government continues to be very proactive on this. I think the thing that we're watching is that the government continues to find solutions to these problems. Unfortunately, the latest set of measures relating to the whitelist don't seem to be kicking in very quickly. So sales in the first quarter are still very weak and actually weaker than what most of us expected. So the whitelist may need yet more time to take into effect. And in the meantime, it seems that the government is not sitting on their hands and waiting, and they're trying to find other ways to tackle this problem.
Have you noticed an improvement in sentiment? At least you talk to a lot of people in the market.
Well, among investors, sentiment is basically more or less the same. Among home buyers, we're seeing sentiment take a step back. And this is showing up in the first quarter sales numbers. Some of the sales figures that we've seen, even for the biggest and government-owned developers, are down anywhere from 30 to 35%. So that's quite a big drop, and that's coming from people who are still quite concerned about the delivery of homes that they purchased, getting homes that they purchased. So that sentiment doesn't seem to have really been reversed by the whitelist. It may probably need more time for that to really be anchored. But as it stands right now among the home buyers, it seems that the sentiment is still quite weak.
And property obviously has been what drove a lot of the defaults in what you're calling the second wave. Where are we now in this cycle?
Well, we're in the trough of the second wave, basically at the bottom. So in this year's study, this is a study we did every year. Every year we try to find something notable to say. 2 years ago, we noted that the market seems to be seeing bigger and bigger defaults, and that the government's tolerance for it seems to be getting higher. And lo and behold, a couple months later, Evergrande fell into distress. So this year, what we found is a distinct wave-like behavior of these defaults, and these waves don't seem to be timed with economic cycles. They seem to be timed with policy cycles. So we found that when you kind of map it to the contractions in the financial markets, that the major contractions, particularly in shadow financing, seems to have been triggered by some of these major policies. First in April 2018, which is a fight against shadow financing through the asset management market, and then in January of 2021, when the 3 red lines against the real estate and excessive leverage policies came out. And in both of these instances, we saw a major contraction in financing conditions and the wave of defaults that followed. So this is something that we're looking at now. The concern, I think, that we get from this year's study is that the default rates now are so low that it doesn't look like a result of the functioning of the market. Right now, it's about 0.2%. Globally, it's about 2%. So that gap is quite wide, and to a certain extent, not particularly natural. So the question that I think in our minds is that what's going to happen with some of these directives against bond defaults in the market when that gets taken out? What happens then? Are we going to see another wave? Because then the government will be in a position to allow the market to function. So that's what we're watching for in the near term.
Do you think they've loosened policy enough to prevent, as you mentioned, arguably the 2 waves were caused because policy was too effective to some extent? What would be the trigger for a third wave? Do you see a trigger? And what would be the natural default given that we get a quicker result?
Well, I mean, the natural rate, I suppose, if you want to compare it globally, that's probably the place where we start. Right now, it's about 2% range, whereas China is 0.2. So that's a very low default level. Now, when the government starts to allow the markets to function, one thing I think we need to keep in mind is that it's not necessarily the government's objective to to eliminate or to reduce defaults. The government's objective that they have stated repeatedly in the recent years is to improve the efficiency of growth in the country. And if efficient growth is what they're looking for, then you need to ensure efficient capital allocation. And the bond market and the functioning of the bond market is very important for that. So at some point, perhaps when the government is more comfortable to allow the markets to function, we should see default rates go back up to a more normal and typical level.
What's normal? What's a reasonable level now for default rates in your eyes?
Right now, if you compare it to the global benchmark, it's about 2%.
Okay. What does this look like for 2024 then? You mentioned if we start to see those default rates pop up, are debt restructurings going to be, you're going to see more of that? And is it really just be focused on the property sector, or do we have to broaden it out a little bit wider now?
Well, the restructurings are happening right now, and we're seeing more and more cases of restructurings happen, particularly in the real estate developers. And I think that's because a lot of these cases have dragged on for a year or two. So it comes in the aftermath of the default wave, and we're now in that aftermath. So we see more restructurings, happening, and also we're seeing more winding up petitions. Investors are getting impatient in some of these situations and filing winding up petitions. So the next thing we should be seeing is more of these restructurings occurring, but perhaps at the same time more defaults occurring when we get into a more normalized market condition. Just one thing to note is that if these defaults are timed with policies rather than economic cycles, since policies tend to be counter-cyclical, we could very well see defaults pick up at the top of the market, not the bottom of the market.
As the economy improves counterintuitively.
Yes.
I wanted to then ask you about, the function, is it around the functioning of onshore bond markets? Because what a part of it has done is, corporates who haven't been able to access the bond market are now looking at the banks for that financing. Are you seeing that dynamic start to shift back into the bond markets? Who dominates the onshore bond market this year, for example, in terms of supply?
Well, you're right. Over the past year, the corporates in the country have increasingly shifted to banks. I mean, they've historically relied mostly on banks.
On banks anyway, okay.
Yeah, exactly. So, but that percentage went from 85% to 88%. So it's quite an extreme level. And to a certain extent, that's not necessarily what you want, because you do want some market forces to play out in allocation that you get in the bond market. So over-reliance on the banking sector is not necessarily positive. So we would expect that to also go back down to a more normalized level. That's something that we're seeing a little bit this year. So issuance onshore has ticked up in the first couple of months. So that's a positive sign. Hopefully that continues, and we see more issuers come to market, and more of that play out.
Are those private issuers, or are those mostly still sort of the LGFVs of the world, for example?
Mostly the stronger LGFVs.
Stronger LGFVs.
Exactly. So in the last year, we've seen the weaker LGFVs essentially, get shriveled out of the market, and the private issuers have also seen very little issuance. So both of those groups are, seeing very limited issuance or net negative issuance, really in the last year or two. So it's the stronger LGFVs that have been able to access the onshore markets unimpeded. But even for them, the issuance level is quite low from a historical perspective.
Charles, fantastic report. Hi to your team for us as well. Charles Chanda, MD Greater China Country Lead for Corporates at S&P Global Ratings. Right, Hang Seng Index. Oh, there we go, 18,000 now. So this should just put us within reach, if not already on track to enter a bull market. More on that story just ahead. This is Bloomberg.
For the first, call it 18 years of Chipotle, this was, you come in Chipotle along the line, you interact with the crew, you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's already right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that.
Right, welcome back to shows here. So let's talk all things markets here. So okay, our CFO here says he doesn't see any Fed cuts this year. So Robert Levin was speaking with Bloomberg after the firm's first quarter profit topping estimates following a new reporting metric, KKR rather. There we go.
Since the beginning of 2022, we've raised about $180 billion of capital, which is a really healthy number for us. But we've been able to do that within a lot of our large flagship strategies in the market. So as we've talked about to go forward, we've talked about fundraising being able to accelerate from here. If you look at where a lot of that capital raising has been over the course of the past, number of quarters, in Q1, we had a final close of $6.4 billion in our Asia infrastructure strategy. That's the largest fund by a good margin in Asia Pacific focused on infrastructure. Lots of real good tailwinds there in terms of longer term growth. A lot of capital raising across our credit franchise, that's asset-based finance, that's direct lending, leveraged credit, north of $20 billion in just this quarter alone. So there's a lot of momentum for us across capital raising, and we would expect that to accelerate. What we've articulated to our investors is we believe that we can raise $300+ billion of capital over the course of the next 3 years.
How do you think about what the investment opportunity looks like with rates potentially staying at this level or not much lower?
One of the unique things about our model, right, is we have over 200 companies that we're invested in across the globe. So it gives us a pretty good lens into what's going on from an economy standpoint. And we're seeing goods inflation come down. We're seeing shelter inflation come down. We are seeing core services inflation remain stickier. And we've been feeling this way for quite some time, and we've been able to position our portfolio to be able to address this. And so we do see interest rates coming down over time, but we don't see any cuts in 2024. We would expect the 10-year to probably come down to somewhere around 4% plus or minus. But all been very front of mind for us as we pursued investment themes. We've been focused on businesses now for some time that we feel can sustain margin in a higher cost environment. You're really seeing that play out in our portfolio, really healthy we've driven real investment performance on behalf of our clients again this quarter and over a longer period of time, so we're quite proud of that. And back to areas where we've been leaning in, asset-based finance, infrastructure, both have a component of inflation protection baked into those asset classes.
KKR CFO Robert Lewin there. Take a look at this market, and Hong Kong is finally waking up. It seems like they just need a few minutes to wake up and come to their desk. Need a bit, right? I mean, it feels like almost like a Monday, but it's not. There you go. 18,000 back to those levels here. It's a day 8 if we continue to see it end this way. And in fact, if we are actually closing at these levels, we are set to really enter into a bull market by the end of today. So we're up about 1% or so for H shares, 1.5% moves there. HS Tech, there you go. Things are really firing up here. We're up about 2.6% overall, and we're checking very closely what's really driving this. EV sector certainly is something to watch. Casinos are doing very well here today as well, Dave.
Yeah, so Sense Time is up again. It might also have to be one of the big movers here as well. Are we looking at 8%? Yes, we are. So you're looking at NEO up 19, Sense Time is up 10%. In fact, no, it's not the opposite. They're both up 20% as we speak. Mayflower, we're still trying to figure out what's moving. I've been looking at some of the headlines. We can't quite figure out just yet, but as you can see, that's also adding Valley, across some of the EV places the water's coming out. We're just headed into the Tokyo lunch break where we are ever so slightly just above water. And dollar yen has been all over the place this week, 160, 153, we're back to 156. And flat, there we go. Plenty more ahead, this is Bloomberg.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies, and I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price may go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you just said, why would you not put a big short of some type on cryptocurrencies, or maybe you have, but do you think that's a good short?
Well, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. Shorting a bond with par that has a limited duration and trades at a 1% spread of treasuries, we can lose more than the spread in the duration. Yet if it defaults, we can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, went from 5,000 to 45,000, it would be wiped out on the short side. So it's just too low to short.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
The whole game plan is basically unchanged. We're going to keep rates here until we're highly confident that we're going to get inflation down to 2%. No hint whatsoever of a rate hike.
I think there's a lot of relief here that the chairman stayed true to what we've seen from this chairman.
I think Jay Powell was particularly disciplined here. I think he stayed on message very well. There's a clear bias towards easing, and he stuck to that.
Well, not quite yet, but why have the program to be less than they expected on the inflation front?
Let that type policy work for longer. I think that's about as far as they're ready to go today. That's hawkish in May. We'll see what hawkish might look like in June.
This is really good for the markets because here's a Fed that's telling us, look at the longer term. Look where inflation was and look where we've got to. Don't worry about the last couple of months. We'll see what happens there.
All right, some of our guests reacting to the latest Fed decision. Welcome back to watching the China show. Asian markets are doing this. There's a little bit of that optimism flowing through some of the equity markets here in Asia. Certainly one to watch. Hong Kong certainly is getting fired up all of a sudden here. So, we don't really need those southbound flows, it seems, here today. We continue to see quite a bit of outperformance there, and that's why that's punching the Asia Pacific index up about 0.7%. U.S. futures are continuing. That's like session highs right now, and the dollar continues to stay pretty weak.
Yeah, so the markets have been taking this one well. Just a couple of things to note here. So we are going into Apple's coming out with earnings. That's number one. And number two, of course, the jobs report. And maybe this may be, something like we had before we enter it. By the way, that market is shut tomorrow. So not that would be they exclude any possibility of a big move in dollar yen, but just to watch that as well. Right. Let's put all things together for you, market-wise. John Woods, Asia CIO, Lombard Odier, joins us right now. Nice to see you.
Nice to see you.
The takeaway so far from this Fed meeting was good for markets, good for risk assets. Agree? Disagree?
Yeah, no, I agree. I mean, the market went in quite concerned that there was going to be some hawkish shock from the Fed. That didn't happen. In fact, if you look at the implied probabilities, both from interest rates all the way down to the performance of bond yields and the dollar, actually there was a small positive dovish tilt. subsequent market. So our view is that this base case of a decelerating inflation or a mild recession, a mild soft landing is likely to play through. And so I don't think there's any major risk to base cases around the market right now.
Do you think rate cuts are just delayed, not so much derailed at this point? Do you think this is a Fed that can still cut in the second half of this year?
I mean, the market is pricing in only a moderate possibility of that happening. Although I would point out we've gone from 7 cuts at the beginning of the year to less than 1 at the end. So the pendulum is swinging, I think, in quite a volatile way. Once the disinflationary trend begins to reassert, and I do think that's going to be apparent, even in the jobs market, in the weeks and months ahead, I think maybe interest rate cuts will get repriced.
What's the prescription then? 60-40. On the 40 part, is it more duration? On equity, should I build more exposure to equity markets at this point? S&Ps are back to 5,000, for example. Very low.
From an allocation perspective, actually, we're tilting closer to 50-50 right now. We're biased towards fixed income. We have an overweight there. We suspect that once interest rates do start to cut, then we will see a rotation from cash into bonds. In particular, a mid-duration, David, to your point, in the IG space. That's where we think the sweet spot will be found, and that's where I think the highest likelihood of capital gains is likely to come from. But at the same time, earnings are looking quite resilient, quite constructive on the equity side.
Yeah.
So that 50-50 allocation, I think, makes some sense.
Is that still mostly in the U.S. then? Is there any other equity market that you see in this universe that could actually beat what we're seeing in the U.S.?
I mean, we're obviously buyers on dips of countries like Japan and India. These are major markets. Maybe China not so convicted, but yes, it's overwhelmingly a US story for now.
Why not China?
I think China's a tactical play, David, right here. I think it's a trading opportunity coming from, I think, a very light positioning, particularly amongst foreign investors. And we're seeing some flows into that, particularly as they rotate out of tech. I think that will benefit China over the near term. But my sense is that consumption as a swing factor, which for me in China it is, still remains quite depressed broadly. I look at retail sales, I look at home sales, I look at consumer sentiment broadly, and I don't see any green shoots in that critically important space. And until I do, I think I'm looking at the equity market as something as a short-term trading opportunity rather than a medium or long-term investment case.
So the U.S., I'm just wondering though, then, if that's still the better, I guess, house in the street, is the earnings picture going to be able to sustain this rally in some ways and maybe overshadow what we've been hearing from the Fed?
Well, we're getting Q1 numbers now, aren't we? And again, they're not remarkable, but they're not unremarkable. We've seen EPS growth of around 6-7%. We're looking at earnings growth for the whole year at around 10%. And in my mind, that is looking reasonably constructive. I mean, perhaps not as good as last year, but next year, 2025, earnings growth particularly will rise to 13%. So I think you can make a case that earnings is likely to sustain performance, and ideally, breadth of the market starts to widen as well.
You mentioned Japan. What's the case for Japan now that we're at 40,000? That the bulk of the data are not behind us but ahead of us, for example?
Well, over the medium to long term, David, I think this is a consumption story. I think this is a renaissance in Japanese consumption. It derives from the shrinking working population, upward pressure on wages, greater spending, greater corporate revenues and subsequently earnings and profitability. That's where I think the case is. It's very much a domestic story. I don't think it's so much a story driven by foreign investors. And certainly the weak yen has helped derive and generate momentum and gains from that side. But into the medium term, I think this is a domestic story, actually, and I think it'll be Mrs. Watanabe essentially selling bonds and buying equities, which is exactly the opposite to what I think will happen in the States. But Mrs. Watanabe will be unwinding her position in post office savings, which is essentially a JGB story, and putting it into equities. And I think that's the next leg higher in the Japan equity case.
What do you make of what's going on in the currency, though? I mean, just given the massive volatility obviously, that we've seen.
Yeah, I mean, to me, that's
Is that going to be a factor for the equity market?
It is quite concerning for me, and I think we've already actually seen intervention. We won't actually have hard evidence of it until the end of May, but I think we're already actually seeing intervention, and that's probably necessary to smooth the yen into the second half of the year. But actually, when you look at Asia as a whole and observe the extraordinary yen weakness we've seen, we start to get concerned, don't we, about relative levels of competitiveness, particularly with China. And you'll probably be aware of these deval stories coming out of China on the back of the gold speculation, on the back of southbound flows into H shares, all these potential currency hedges. And you have this sort of Damoclean sort of yen weakness hanging over everything. So to me, that is a risk that I'm quite focused on in the Asian space.
I mean, we've watched this market for a long time. We were talking about this a few days ago. I mean, the yen went from 85, 90, 60, it's effectively half in value over 10 years. Why hasn't that been a problem? It's just been bizarre to me how no one's really pushed back on that.
Well, I mean, in previous instances, David, of course, you'll be aware that it actually caused a huge amount of turmoil and volatility in global currencies, and we have these very famous Plaza reports, etc., which were convened to address that. I think right now the monetary phenomena or the monetary imperative is overwhelming yen weakness. And actually, if you look at renminbi, if you look at euro, if you look at the dollar, they've been relatively well behaved. Actually, it's only the yen that's gone AWOL and off reservation. Were they really to start tightening monetary policy a little more at the margin, I think possibly you could start to see some strengthening with the added threat also of
Okay, John, thank you so much. John Woods, their Asia CEO at Lombard Odier, joining us here in the Hong Kong studios. We've got plenty more ahead. This is Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, by building a sports team that can perform at the best, but also talking a lot about the explorer spirit, how can we really tap into new things, continue being disruptive. We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
All right, there you go. It just takes up from 3% here right now, and we are seeing this Hang Seng really getting into that bull market territory here if we continue to see these gains of about 300 points or north of that here this morning. 18,066 for your Hang Seng. It's an 8th straight day of gains. Looks like we're continuing on this winning streak here, the longest we've seen since 2018. We're talking about one other story here right now. The U.S. is barring a Huawei laboratory from improving telecommunications gear for use in the U.S. The FCC has also proposed similar moves against other providers, including several Chinese companies. Let's to our executive editor for Asia Technology, Peter Elstrom, joining us from Tokyo. Peter, just maybe tell us how significant this move might be, and what is the U.S. essentially trying to achieve?
Yeah, sure. It's a little bit of a strange development. So the Federal Communications Commission, the regulator for telecom communications in the U.S.,
is deciding to ban Huawei and some of these other companies that you mentioned from participating in what's really the authorization of technical standards for gear that's sold into the United States. So the FCC relies on these private labs to do a bunch of testing around, do things conform to technical standards like radiation levels or what frequency certain things are operating at, and Huawei had been participating in that. That's probably a bit of a historic artifact. Huawei, of course, had been very active in telecom networking equipment and smartphones and the like, and in the past had probably participated in these kinds of technical authorizations. But more recently, and this has been going on for years, the US government has been cracking down on Huawei. It's been barring its equipment from being used in the United States. It's also gone to allies and tried to get them to pull telecom equipment out of their networks because of national security reasons. So there's a little bit of a leftover artifact here that Huawei was still participating in these kinds of authorizations.
Peter, let me combine just two questions for you. I suspect the answer to one will be very short. Have you heard from Huawei as a response to this, number one? And number two, on Huawei, but in a different story as well, we're getting some numbers coming through eclipsing Apple. What can you tell us about that?
Yeah, on the first point, we haven't formally heard from Huawei on this front, although it has said repeatedly that its equipment, its company does not represent any sort of national security threat, so it's been very clear about that point. You're referring to their earnings, in your second question, you're referring to their earnings for the first quarter, very strong results out of Huawei. Their profit, probably the headline number is that the profit increased more than 500%, so just a huge explosion of profit at this point. They don't give a whole lot of breakdown about which businesses are doing well. The company's two primary businesses are telecom equipment, so what you put into the backbone of telecom companies around the world, and then smartphones in particular. And it almost got knocked out of the smartphone business because of the blacklisting from the United States. It couldn't get key components, including semiconductors. But as we've reported, we've talked with you guys about a few times, they now are getting some of those semiconductors that they need for their smartphones domestically, and that's led to this huge increase in their smartphone business. We saw shipments up about 70% in the first quarter, and as you alluded to, that has hurt some of the foreign players, particularly Apple, which has lost a lot of ground as Huawei has sort of come on strongly.
Peter, thank you. Peter Elstrom, our executive editor for Asia Tech in Tokyo. For us, we'll leave you with a look at currency markets where it's generally a story of a softer dollar, but curiously also a softer yen. So the comments of our previous guest, John Woods, the yen's gone AWOL. This is Bloomberg.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time, I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Flip Adams is a really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicts them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
As we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate, and banks that deal in that. Maybe a more nerve-wracking place, how that shakes out in cities. So those things worry me, but not especially even before SVB. I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
Welcome back to watching the China Show. China's top climate chief is set to meet his U.S. counterpart in person for the first time next month. Speaking exclusively with our colleague Stephen Engel, the Ocean Man says he also sees common ground for the U.S. and China to work together on climate issues.
I shall bring a delegation from different ministries and looking at different issues.
I think we are looking for to have a very sincere and practical conversation with our U.S. counterparts. We have to start the cooperation with in some areas.
How do you see in the United States, they've had a changing of the guard as well. Mr. Podesta, how do you see that relationship building?
Between China and the United States, we had relatively good cooperation ever since the last 30 years for the climate change process. Of course, over 30 years, during the Bush administration and during the Trump administration, U.S. stayed away from the climate process. But on the rest of the years, we had very good collaboration.
Is it even possible to have a separate dialogue, even diplomatic dialogue on climate? Because there are a lot of other very contentious issues that are clouding the U.S.-China relationship. Is it possible, or would you rather see a more dedicated climate dialogue in separation from the other issues that, whether it's the South China Sea or geopolitical relations, that's really clouded and deteriorated the U.S.-China relationship?
China-U.S. relations are very, very complicated. But I think for climate change, both China and U.S. have a common but differentiated responsibility, and we have to cooperate. And as far as possible to continue to lead the global process.
What happens if Donald Trump is reelected? What's your view?
And that's one of the worries in this climate change community. I definitely hope that the American people will support the government to stay in the climate change process and stay in the Paris Agreement and even Trump wins the next election.
In March at the Global Forum, you said protectionism and economic competition are becoming another problem for the global fight to combat climate change. How much is this holding back the global fight for climate change?
When I mentioned that issue, I think that I'm focusing on the impact. If it is protectionism in electoral measures, it's a non-trade tariffs. Well, definitely, if our partners, like North American and the European partners, continue to follow this practice, not to talk about trade, it will impact a global process. If the Western countries continue to insist to decouple from the imports of the China products for clean energy, it will cost the world for maybe additional $6 trillion. It means a 20% increase of the overall cost. We need to maintain the low cost. Nobody going to afford to work for this energy transition process.
And officials in the U.S. and Europe claim that China is giving unfair subsidies, and that has led to the situation we're in right now that could distort global trade in these clean products. How do you respond?
I think if what you would call the European Court is going to really to talk with our China government, because our things that we use energy equipment technology, they are innovated and developed and manufactured by our private companies. This is very unique, very unique. I think private companies normally they don't receive any government subsidies. I think we should really highly appreciate the dedication and contribution by these enterprises. So after more than a decade of their hard efforts, now we have a cheaper both solar and wind products which were not affordable to start the energy transition. I think it is good for both for China and both for the world.
Capacity. We have to also talk about the domestic economy here because we've been seeing profitability sink at a lot of these solar companies and EV companies. Price wars are driving down their margins. What does that do to the climate fight?
If the world is bifurcated on trade, we can talk about capacity in two different ways. For the global demand, and whereas China domestic demand, we're still in high demand for the renewable energy products. Because for the Chinese government, I think we're determined to increase our renewable energy capacity to a high percentage, maybe over 80%. I think for the next decade, we're still in the process of increasing our renewable energy capacity. Globally, I think that's much slower than what Chinese were doing. So there'll be a high demand
for the renewable energy. But for the so-called overcapacity among the manufacturers, among our giant manufacturers, it's a temporary issue. It will be also good that be through this kind of competition, they can continue to improve their manufacturing and make much more better products.
That was China's special envoy for climate change, Liu Junmin, speaking exclusively with our chief North Asian correspondent, Stephen Engel, in Beijing. Checking these Hong Kong markets now, and it is on fire. These tech stocks, HS Tech is catching a massive video this morning. Wow. 29% gains for Sense Time. NEO is also up to 23% the back of those April delivery numbers. Meituan Expo, these are some of the big tech heavyweights that are really punching up much higher here this morning as well. So the tech space is doing very, very well. We're watching property as well. China Vanke, there you go. It's up 11%. So there's talk about China banning these cities with big home stockpiles and new land sales. There's Politburo meeting talking about they're finding solutions to deal with the inventory side of things, or at least a supply issue in China. That's lifting this industry here. Particularly long for is also up close to 9%. And we're watching the move in oil, obviously, with that drop in oil prices. We talked about WTI back below $80. That certainly is leaving a drag here, at least in the energy space. You're seeing it looks like PetroChina down some 3%, Dave.
Yeah, more in this market, right? So the Hang Seng Index, MSCI China are now up 20%. We just stopped short of that early this week. So as things stand, we are on track to enter a technical bull market, which is 20% from a certain low. Maybe more in that Politburo meeting that took place, because the type of price action you're seeing in property in particular, when you get a day where you have 10-15% gains, is indicative, based on what we've heard from our guests, of really a sea change on policy and the magnitude towards property, right? So in the Politburo meeting, for example, one of the things that stood out was it was the first time in a readout from that meeting that they mentioned either interest rate cuts or interest rates specifically, or reserve rate reforms. The first time it mentioned those two things, policy choice, since April 2020. What happened in April 2020, that's when the pandemic first hit, and China's economy, of course, was trying to get itself stabilized.
So at least there's a chance that monetary policy could still be a big play. Maybe later on this year. You have to wait maybe until the Fed moves or the ECB moves, right? I think B was saying that's in line with what they're projecting here, that we could still see some cuts when it comes to RRR, when it comes to maybe even the LPR. But I think that what I really took away from it was these studies to suggest how to digest the supply issues here. There's something new that's coming through in the property market, and I think people are reacting in a big way on that too.
Yeah, next now would be to how they fund that as well, and how they do the inventory.
Right, these are numbers behind it.
Absolutely. Okay, we'll leave you with that. Positive end to the show, 4% on the HS Tech Index. Plenty more ahead. This is Bloomberg.
Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Emery O'Dern only on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you can also have a huge impact by trying to do things like carbon capture and so forth, right, around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And what was more striking is the fact that the demand for it is going up everywhere.
Things like solar or wind, it's nice and environmentally friendly, but really it's not gonna be produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, so solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. When we do a breakthrough, we look at technologies that can produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is that we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
Why do the biggest names in business choose Bloomberg? Great question.
Great question.
Great question. Great question. Next question I get all night.
Bloomberg, top experts, great questions.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, agriculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera. And I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day you might be able to write poetry.
It's almost 1 p.m. in Sydney, 11 a.m. in Hong Kong and Shanghai. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. The yen's weakening extends, carrying a surge on suspected intervention that saw the currency gain 3% in just minutes. Asian stocks gain as Fed Chair Powell sounded less hawkish than expected. The Hang Seng poised to enter a bull market with the longest win streak since 2018. And we speak to German software giant SAP about how it's helping customers utilize AI and cloud technologies. Ahead of that, though, we're going to be joined by Rebecca, head of Asia Fixed Income, with her strategy off the back of the Fed's rate outlook. First off, though, let's check on how markets are doing. We've only been trading China today, but Hong Kong is up and running pretty strong. What are you watching, April?
Yeah, we're seeing a lot of upside in Hong Kong, but in general, it's a bit of a mixed bag across the Asia Pacific. Although we are seeing some gains, it seems here like investors were bracing for a more hawkish Fed. What we got was a Fed that downplayed that the imminent move would be one of a rate hike, and also those signals that it will slow the pace of the shrinking of its balance sheet to ease the pressure on money markets. Yet Powell also signal that, while keeping those rate cuts on the table, they might not come so soon, especially given how he sees inflation in the country. Have a listen.
In recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks.
Lack of progress on inflation, that is the highlight there. So that's why perhaps we're not seeing that much convincing moves to the upside. The Kospi is down. We're seeing Nikkei futures also pointing to a slight gain where markets return from their lunch break. But as I say, the focus has really been on the Hong Kong stocks. Quite a rally, a world-beating rally, despite the crucial pillar of support today, mainland investors, because of course, China, as you say, is shot. And a lot of the upside that we're seeing might be
thanks to what investors are expecting, that optimism from Chinese tech names earnings that are due in the middle of the month. And we also have the Hang Seng that is poised for its 8th winning session. This will be the longest streak since 2018. It's also edging towards about 20% gain from its most recent low. So that would mean the technical definition of a bull market, although of course this is from a very low base. Now, among the currencies, we're also keeping a close eye on the Korean won. And don't forget, we did get some of the inflation numbers out of Korea today, and the weakening in general, though that's not what we're seeing today, of the Korean won might pose some challenges for the BOK in its fight against inflation. The CPI print did show a cooling that was better than expected. Now let's take a look as well, if we can, on the Japanese currency, because it's not just the Korean won that we are focusing on. It's really been about dollar yen. And remember how earlier in the week we saw that move sharply. More recently, the yen had weakened towards the 157.5 level after Powell spoke, and then a sharp move towards the end of the New York session towards 153, smelling a lot like intervention. The currency chief saying he cannot say anything about intervention, but note here that we are seeing that weakness, and it's those yen bears really testing how far Japanese officials will go in defense of the currency pole.
All right, thanks very much, April. We're getting some breaking news from SK Hynix right now. We've got news that memory chip orders almost now fully booked until 2025. SK Hynix says it's also going to commence mass output of next-gen high bandwidth memory chips in the third quarter. This is according to exclusive reporting from Bloomberg. We're seeing SK Hynix a little bit off the pace in Korea today. But the news being reported, SK Hynix will aim to begin mass production of its next generation memory chip in the third quarter, seeking to capitalize on that surge in demand for semiconductors, which are of course essential to AI development. But it's also saying that 2025 production for that high bandwidth memory almost fully booked. So that really does underscore not just the boom in intelligence services, but also just how much demand is outstripping supply at the moment. All right, for more, let's bring in our MLive strategist, Mike Cranfield. Mike, I want to start with that rally in Hong Kong. We've got stocks up for an 8th straight day, and tech performing particularly strongly.
Yeah, there's a couple of things which make it all the more impressive. As Ava was saying, China is out today, so there's no inflows today from the mainland, which obviously would normally be a good factor for them. Also, it's impressive because if you look at the performance in the last couple of weeks, it's been against the trend of what we've been seeing in the United States. So even though S&P 500, NASDAQ contracts are gradually been coming lower, Hong Kong markets have done pretty well in the face of that. So that's again, that's a good sign. Clearly there's some optimism here about what's coming up in terms of tech earnings. We've got the big ones. We've got Tencent, Meituan, Alibaba, Xiaomi are all coming up within a very short period of time. They report within 2 days of each other. And given what we've seen from the US tech companies and some of around the world, even that news you just spoke about Hynix there, that is also going to be a positive for Hong Kong as well. Because if they see improvements there, they'll translate that as being positive for their own companies as well. So certainly there's optimism that when the first quarter results come through for the big Hong Kong tech companies in a few weeks' time, that is going to be another booster. It may well be we'll be able to continue to keep the good move going until we get there. Then the real test will come. People want to see the hard numbers, and if they genuinely beat, then maybe the rally can continue.
All right, MLive strategist Mark Cranfield is going to stick with us. We'll talk about the Fed, the Bank of Japan in just a moment. We do have plenty more to come. This is Bloomberg.
will sit like this. $1,500 movie. I don't want this flight to end.
Reach and resources from more than 120 countries. The moment news breaks, 24 hours a day. Bloomberg, context changes everything.
A little bit about that rally that we saw on the Hang Seng. Texas doing particularly well. Let's get back to our MLab strategist, Mark Cranfield. And Mark, seems like Hong Kong didn't really get the memo from the Fed. It was a bit of a masterclass into how to say something without saying anything at all. The Fed promising it's not going to lift rates. Is that pretty much what passes for dovishness these days?
I think between the lines, it was not a dovish outright statement as such, but it was a lot less hawkish than people had feared going into that FOMC decision. And the two highlights obviously are one, as you say, you mentioned the fact that rate hikes are not really on the table, but probably more importantly, for the bond market especially, the talk about the QT. So the fact that they're going to reduce the speed of the balance sheet rundown. So it's going to come down to just a pace of 25 billion a month from currently 60 billion. And that's a much bigger change than people had expected going into the decision. So that's a good sign for the bond market. It also comes in more quickly as well. It's going to start from June. So they brought it forward. So in a way, that's like a kind of a stealth easing in itself, because it takes a lot of pressure off the bond market. If it does that, that's also beneficial for the equity market as well. So from a portfolio point of view, if you're an asset investor in the US, you've got some relative good news there from the Fed and from Jerome Powell. It's not obviously as encouraging as saying interest rate cuts are going to start very soon, but at least under the circumstances, it was a much better outcome than people had seen before the Fed meeting.
Yeah, perhaps not the news that policymakers trying to defend the yen in Japan were really looking for either. And we saw another big move today, raising the question that we'll have two interventions now this week. But the question, I think, is, where does the ammunition for this come from? I mean, it comes from foreign reserves, but how much ammo does the BOJ have? How many more interventions could we potentially see?
They could probably do quite a bit more here. There's been talk that the amount of ammo they have is somewhere in the region of $150 billion in total, without going to ask the authorities of the government for even more, which they could do. But let's say they start on that premise. Well, it looks as though they've spent around about $35 billion on Monday. They probably spent a bit more last night. So they're probably not even halfway through that current amount of money they have for intervening. And they do need a lot, because these days we're talking about a foreign exchange market which runs at about $7 trillion a day. So you can see you need to throw a lot of money at it. The last time the biggest move they had came with $60 billion worth of US dollars sent into the market. So we were talking about very big numbers. It needs to be built up over a period of time. Now we're going into a long weekend for the Japanese. They're off on both Friday and Monday. They had quite a bit of success, it seems, on Monday, which was also a holiday. So people are really on the edge of their seats here, expecting there's a decent chance they will add to what they've been doing this week, possibly tomorrow, if not again on Monday. And really the aim here is to get dollar yen below 150. If they can do that, it probably have a little bit of momentum in itself, because traders will want to go with the flow. If it doesn't go below that line, it's going to be much more difficult for them. And of course, as you said, they didn't get a lot of help
from the Fed last night. They would have probably hoped for a little bit more. In the meantime, you can expect that they're probably going to push a little bit harder just to get traders on their side.
All right, in-line strategist Mark Cranfield there. Let's now get a little bit more on those moves, lack of moves that we saw from the Fed, but the moves that we did see from the yen. Tuha Cha, head of fixed income Asia at Rebecca, joins us now. Tuha, I just want to start off with what we heard from the Fed today. Really not a lot of new information there, remaining data dependent, ruling out a hike. Have you given up on the idea that we're going to see any easing at all in 2024?
I guess there's still some possibility, but definitely pushed out to probably the very later part of the year, given how much data that is going to require them to be able to move anything. But I think the thing that we actually probably need to be focused now is obviously the inflationary pressures there, but also how the economy is doing. There is definitely some signs that it is beginning to be, there is some pressure on it, and I think that is equally important for the Fed to make sure that we don't have the economy kind of slowing down so that we have to worry about stagflation in any form.
Yeah, stagflation definitely becoming part of the conversation again. Data dependency, that's the buzzwords that we keep on hearing, but we're going to get an important piece of data this week with the US jobs report. What are you anticipating there? Do you think it's going to change the picture at all for the Fed?
I think of course it's going to be really quite important because you've got one end of the equation, inflationary pressure doesn't look like to be receding. If we get a very difficult jobs number that indicates that actually the inflationary pressure is actually also negative for the jobs market, that so which would actually not necessarily helpful for productivity and others, so that's going to be difficult. So I think a number that's too high or too low is going to be problematic. The one that's kind of within the range is probably the best for the market, I think.
Of course, the yen very much at the behest of what happens with that data, what the next move from the Fed is as well. And we've got a chart here on the Bloomberg terminal that just shows some of the wild swings that we've seen in the yen this week, from 160 to down where we are now, 155.94. So we're looking at maybe two interventions now. But I just wonder, how effective do you think this sort of thing is, particularly considering the yen is just hostage to macro events that are beyond the control of the Ministry of Finance?
It is, and I think this is about as much spot dollar strength as it's about yen weakness. But however, there is still some policy that can actually be helpful for the commodity markets looking for, right? How it just the normalization of kind of the JGB market and how effective that we are going to have rates that moving in the opposite direction, hopefully as the Fed. And I think this is where the economics have to actually come into it as much as actually rates action. And I think this is where people are still very on edge about the yen, because that picture is not very clear. What kind of rates can be normalized and actually have that impact on the economy, and that's still very much untested at this moment. And I think that's why we'll continue to see a lot of volatility as the market tries to figure that out.
We might have an opportunity to return to yen policy in just a moment, but I just want to get across a big move that we're seeing in China Bunker in Hong Kong at the moment. We've got that stock of the property developer pushing higher by about 14% right now. So a big move from China Bunker, admittedly off quite a low base. Where do you think we are in terms of China property at the moment? Because these problems haven't really gone away. How are you explaining these outside moves that we're seeing right now?
I think first of all, we come from a very low base, right? And it looks like people feel like the authorities are actually trying to arrest the underlying issue of some sort of inventory and making sure that we don't kind of double dip again. So I think that's why the market is generally a bit more positive. But I think just the cyclical upturn in itself, as we've been seeing for the last few months, is actually helping the market overall from a very kind of very
bearish scenario within China to somewhere where now it seems as the stabilization is coming around some cyclical upturns, and I think that's in a place where there's very few places to hide and valuation is still relatively active. I think that's what's causing some of the news that we've seen recently.
Yeah, we also got the news today that the third plenum is going to take place in July. Now, it's interesting because this is an off-schedule year for the plenum. We're not meant to have one. The other thing we don't have is an agenda at this stage, which is a little bit unsettling for markets. What do you think is going to come out of this in terms of policy?
Well, I think they made it very clear they're using this to front run things that they may have actually thought about doing anyway. Just a bit of a head both, I think, both maybe pushing on both monetary and fiscal policy with this momentum kind of pushing on this cyclical upturn. So I think this is why the market feels like, okay, they're taking action and maybe taking action when the market is already on their side. So actually could be quite nice from both sides of converging, and as it from a very low base. So I think this is why I think the market is getting a little bit more excited about that this could be pushing on a trend that's already there in the market.
In terms of monetary policy, though, do you think the PBOC's appetite for easing is perhaps somewhat blunted by the weakness that we're seeing in the yuan right now?
Yes, and unlike everybody else, right, the US policy is not helping anyone taking the policy in the direction that they would like it to be. But having said that, I think with the yuan, pretty much people accept that that they're going to have to try to cut, and they may do, and I think that's kind of priced in. So maybe the pressure on the yuan may be less than some of the other currencies out there versus the dollar.
All right, well, you specialize in fixed income. I'm just wondering how you're managing your fixed income portfolio in Asia under the current environment, especially when it comes to credit.
Yeah, but I think definitely credit spreads have actually, really outperformed this year, probably at some of the tightest levels. So I think here we really are focusing on an up in quality trade because, I think the market is very kind of already very optimistic on spreads. And I think secondly, differentiation, we're also focusing very much on bottom-up ideas because the market doesn't seem to be as differentiated as it was only several months ago. And I think we're also looking for bolts of volatility, which we still expect to be kind of a good opportunity to buy on dips, and we can see bolts of volatility every now and then, given the macro conditions.
All right, Thuha Cha from Rebecca, thanks so much for joining us with your insights. We do have plenty more to come. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
Great question.
Great question.
Great question. Next question I get on
Bloomberg, top experts, great questions.
Ways on the heartbeat of this
Right across global markets.
Real-time data aspect is going to be, and we're going to bring you
expert analysis from that. Don't miss Bloomberg's interview with them.
Okay, so you're moving in on me quick, straight with your fancy hands. I'm going to deal with your knife because it's really bothering me.
My legs.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I concede. Got me beat.
Very big man. Well played.
Thank you, sir. Thank you.
today, really, considering the rather, well, nothing burger statements that we had from the Fed a little bit earlier on. Other markets looking much less exuberant than this. We've got the Hang Seng better by 2.3%. No trade in China today, public holiday there, but the Hang Seng Tech Index really had an outstanding day, better by 4.3% at the moment. And China Vanke, as I mentioned earlier, also performing very, very strongly. That stock right now better by about 14%. The property index more broadly, just a shade less than 3% higher. Well, China's top climate chief is warning the climate fight is going to be too costly without Chinese products. Liu Jianmin spoke exclusively with our chief North Asia correspondent, Stephen Engel. He says Western decoupling could cost the economy trillions of dollars.
If the Western countries continue to insist to decouple from the imports of the China products for clean energy, it will cost the world for maybe additional $6 trillion. It means a 20% increase of the overall cost. We need to maintain the low cost. Otherwise, nobody is going to afford for this energy transition process.
Officials in the U.S. and Europe claim that China is giving unfair subsidies, and that has led to the situation we're in right now that could distort global trade in these clean products. How do you respond?
I think if the U.S. colleagues, European colleagues, going to really to talk with our China enterprise, you can see all these renewable energy equipment and technology, they are innovated and developed and manufactured by our private companies. This is very unique, very unique. I think private companies normally they don't receive any government subsidies. I think we should really highly appreciate the dedication and contribution by these enterprises. So after more than a decade of their hard efforts, now we have a cheaper both solar and wind products which were not affordable to start the energy transition. I think that this is good for both for China and both for the world.
Well, we're talking about overcapacity. We have to also talk about the domestic economy here because we've been seeing profitability sink at a lot of these solar companies and EV companies. Price wars are driving down their margins. What does that do to the climate fight? If the world is bifurcated on trade,
we can talk about capacity in two different ways. For the global demand, as well as China domestic demand, we're still in high demand for the renewable energy products. Because for the Chinese government, I think we're determined to increase our renewable energy capacity to a high percentage, maybe over 80%. I think for the next decade, we're still in the process of increasing our renewable energy capacity. Globally, I think that's much slower than what Chinese were doing. So there'll be a high demand for the renewable energy. As for the so-called overcapacity among manufacturers, among our Chinese manufacturers, it's a temporary issue. It will be also good that through this kind of competition, they can continue to improve their manufacturing and make much more better products.
That's China's Special Envoy for Climate Change, Liu Jianmin, speaking exclusively with Bloomberg Stephen Engel in Beijing. Well, let's take a look at how China EV stocks are moving. Particularly, you want to take a look at NIO. It's jumping pretty strongly at the moment, better by about 22%. That's off some of the session highs that we saw earlier. Now, NIO's reported a 32% jump in vehicle deliveries in April compared with the previous month. Also, announcing the shipment news on April 25th. It's rising tide floats all boats. We've got Exxon and BYD also in positive territory there. What's not positive territory? Oil. That's slipping back just a little. Big jump in US crude is weighing on prices there. All right, still to come. German software giant SAP is eyeing $1 billion investment on AI over the next 2 years. And their chief revenue officer is going to join us for an exclusive interview next. This is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends, we're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger. And those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Basically unchanged. We're going to keep rates here until we're highly confident that we're going to get inflation down to 2%. No hint whatsoever of a rate hike.
I think there's a lot of relief here that the chairman stayed true to what we've seen from this chairman.
I think Jay Powell was particularly disciplined here. I think he stayed on message very well. There's a clear bias towards easing, and he stuck to that.
They've left wide open the question of why has progress been less than they expected on the inflation front.
The Federal Reserve is not living up to the commitment on inflation that other central banks are.
Let that type policy work for longer. I think that's about as far as they're ready to go today. That's hawkish in May. We'll see what hawkish might look like in June.
This is really good for the markets because here's a Fed that's telling us, look at the longer term. Look where inflation was and look where we've gotten it to. Don't worry about the last couple of months. We'll see what happens there.
Some of our guests there reacting to the latest Fed decision, which was to keep rates unchanged, very much as anticipated. Ava, let's check in on how markets are doing in the wake of that. Not a lot of movement really, except for Hong Kong. What's going on?
Yeah, a lot of upside in Hong Kong, but you know how Japanese markets have been moving sideways for much of the session. I think it's really following on from the month of April where we saw stocks there underperforming, and a lot of it had to do with how the Fed pivot rethink was going on. So today it's a bit of more of the same because don't forget what we got from the Federal Reserve is yes, it downplayed that the imminent move is for one of a hike, but given what Powell had to say about inflation, it's not like we're going to see rate cuts anytime soon. So this is what we're seeing in Japanese equities as we come back from the lunch break. Of course, we've been keeping a really close eye on the yen. Earlier, it moved to 153 after hitting about 157.5. Smelled a lot like intervention, but now pushing above 156. Those yen there is really testing how far Japanese officials will go in defense of the currency. Of course, the fundamentals are on their side. It's that yield gap. They're pushing things along. But let's talk tech, because that's in focus today. We got SK Hynix saying on its AI memory chip, those orders pretty much fully booked until 2025. AI been driving a lot of that demand. In terms of mass production of some of these chips is looking at the third quarter. And again, this is really a sense of how we're seeing that AI sentiment coming into the market. So SK Hynix, which declined earlier, managing to pare some of those losses on a day where tech is not really performing very well on the MSCI Asia Pacific, except tech, they're looking at Hansing tech. Chinese tech names gaining a lot of ground today, that optimism coming through about their earnings.
All right, thanks for that, April. I want to bring you some live pictures now from Kuala Lumpur, where we have the Microsoft CEO, Satya Nadella. He's making an announcement in Malaysia. He's saying that Microsoft's going to invest $2.2 billion to build digital infrastructure in Malaysia. It's going to spend that money over 4 years, and that will be building infrastructure for its cloud computing and, yes, artificial intelligence services. So, Satya Nadella is taking the stage in Kuala Lumpur with a $2.2 billion announcement. Europe's biggest software firm is looking to migrate customers from its legacy on-premises system to the cloud. SAP is offering businesses AI services, sweeten the deal, and plans to invest more than $1 billion into the technology over the next 2 years. And joining us exclusively right now, we have Scott Russell, Executive Board Member, Chief Revenue Officer at SAP. Scott, thanks so much for joining us. Let's talk a little bit more about the detail of this $1 billion investment you're making in AI over the coming 2 years. Can you give us some specifics about what exactly you're developing and what the applications of your developments are going to be used for?
Sure. There's no doubt that the growth of AI, it's real, it's not a hype, it's real and it's here to stay. And for businesses who are already on that growth journey, on that transformation journey to the cloud, which we've seen in our results, you saw in our Q1 earnings growing at 25% at constant currencies, here in Asia Pacific, Japan growing at 35%. Businesses are moving to enabling capabilities in the cloud, which is obviously needed. And that means that businesses can then use and leverage the AI. So why is AI so relevant to us? Because we are the business applications leader in the planet. Most businesses, their most powerful, their most important data that they run about their customers, their people, their suppliers, their financial, all sits within their SAP platforms, and they want to unlock the capability that generative AI brings to their daily tasks, their business processes. And that's what SAP is doing. We're bringing that to life with customers around the world, whether it be around sustainability data, whether it's helping them in their supply chains and making them more resilient, driving better financial performance, or simply serving their customers more effectively, pervasively embedded into our applications and enabling them to unlock that data together with publicly available information to their business value.
Of course, one of the stories we're always reporting on, we mentioned it just a short time ago with SK Hynix making that announcement that it's basically sold out of all the chips it's manufacturing until 2025. So a lot of challenges around getting some of the hardware needed for these sorts of developments. In terms of acquiring what you need, how much bang does $1 billion get you?
Well, it's been a journey that we've been on for over 10 years for. So we've got over 27,000 customers that are leveraging our AI capability. Companies here in the region like Cinemas and Hanwha, or business leaders on us in Australia earlier this week, Osnet, Coles and others that are able to leverage this. But the beauty of the AI capability of SAP, which I think the market is demanding, is there are so many large language models. There's so many providers out there. We're able to abstract that, and we are a partner orientated, so we can leverage that computing power, leverage the best practices, but then do it in a secure, reliable way for our customers with that mission critical data. So we're able to do it not only in leveraging the best capabilities that companies like Microsoft and many others who we partner with, but also we're able to then help them manage their TCO and their cost of compute. Because you're right, the demand is very high, but so is the expectation of results. And we're all about business value. How do you use this capability to drive business outcomes? And obviously we see a huge potential with that, including here in Singapore. We've got a lab that we've got for mission critical capabilities of AI, so we've partnered with the EDB to leverage the talent, the innovation right here in Singapore to serve not only the Asia Pacific region, but globally. So leveraging talent pools around the world to serve the market.
I mean, is that where you see the biggest growth? You're Europe's largest software company, but is that not necessarily where the strongest growth is? Are you looking more to Asia?
But there's no doubt that Asia has been the growth engine for SAP for a number of years. So as I mentioned before, growing at 35% in cloud revenue, The beauty is of customers around the world in North America and in Europe are also growing at similar pace. I think what is really important is businesses are global by operation, but they want the data to be governed, resonant, and managed in a really secure way. So not only do we see the growth engine of Asia Pacific and the businesses here, but as they move into their global operations, moving into different markets, they can leverage that capability in a secure manner. And I think one of the challenges around AI from a business standpoint is the ethical and the reliability standpoint. So not only are they using their SAP applications and data for their core mission critical processes, that they have the same comfort that when they apply generative AI, that they have the same guardrails that SAP puts in place, making sure that whatever we do is sustainable and beneficial, and also aligned to the regulatory framework, which is a dynamic place right now around the world, including here in Asia Pacific.
Well, for SAP specifically, your cloud revenue is up. There's no doubt that this is very much a growth area for the business. What's your outlook for this sector in the context of the AI boom?
Yeah, we've been on a growth journey for many years now, and Q1, as you point out, was a very strong quarter. And again, it just reinforced businesses want to do several things. First of all, they want to transform, be able to have resilience and power in their core mission critical operations. And that's what we provide. Business capability to help them to react and respond to the needs of today and tomorrow. Companies like Cinemas, who have got a great SAP history, but they're leveraging our cloud capability to do the next iteration of transformation. But they're wanting the infusing of the generative AI into their core business process. So being able to use that to leverage more insights, whether it be automating their invoicing and document management, being able to use our visual inspection of the supply chain for defects and inventory, being able to then build and then transform into new businesses as they expand around the world. Even companies like Coles, who have got a core capability of running their operations on SAP, but then leveraging the AI capability to be able to provide a better service to consumers in Australia. All of the examples is embedded into core applications, and I think businesses are now saying, I don't want to build my generative AI separately. I want it infused into the way I do my business on a daily tasks, and that's what SAP brings. So the outlook is strong. We're certainly optimistic about the growth for SAP, not only in the cloud, but to be the #1 business application company and #1 in business AI.
We're also living in a complex geopolitical environment where we have the US and some of its allies really trying to squeeze China on chips development, on its own AI journey. To what degree is this impacting the way that you're conducting your business?
There's no doubt that the geopolitical landscape is one that is difficult to navigate for businesses, and I guess one of the things that SAP brings is because we're a global operation, we've been supporting not only Chinese businesses, but over 100 countries of local operation. One of our core value proposition is to be able to ensure that business applications meet the regulatory requirement, including the evolving. And when you think about generative AI, data sovereignty, data residency becomes a critical element in what businesses are looking for, as well as regulators. By our local proximity in markets like China, here in Asia and around the world, we're able to provide that assurance to companies as they move into or operate in those markets, that we can help provide that resilience for them and navigate those changing geopolitical environments. The good news is our investments in generative AI will not only benefit local businesses, but businesses who are expanding globally, and provide that assurance that as they navigate the geopolitical and macroeconomic uncertainty, they've got a mission critical platform that brings the best capabilities that not only wins, but also make sure that they can adapt to the regulatory changes that are no doubt hitting us all.
All right, Scott Russell of SAP, thank you so much for joining us today with your insights. And on the topic of tech, let's take a look at the Hang Seng Tech Index. It's definitely the bright spot in Asia today. We have the broader index better by 3.5%, although so giving up some of the gains that we saw a little bit earlier on. So a very strong day for the Hang Seng Tech Index, and for more on this rally, I want to get over to Bloomberg Intelligence Senior Analyst Robert Lee. Robert, some of these names were pretty beaten up, and as I was just discussing there with Scott Russell, a lot of China tech names have been squeezed by US curbs. How do you explain this sudden rally? Is it just they've got too cheap to ignore?
And Hong Kong market has underperformed for some period of time. So I think since the beginning of this year, really, the index has bottomed out, and we've seen some sort of bottom fishing coming in. So that's something that's been apparent really for the last 2 or 3 months. The market and the index has been going to rally, and that trend seems to be continuing at the moment. So whilst the growth outlook for China tech stocks and HS tech stocks might not match its Nasdaq peers, and particularly the Magnificent Seven, the valuations these stocks were trading on were significantly lower. So I think as well, if you look at Nasdaq and with the index, potentially topping out, and with expectations that potentially having got a bit too high, people are looking for areas where there's still growth to be had at maybe more reasonable valuations. So I think that's one of the key reasons. Very briefly, as Admiral Hong said earlier, we're heading into earnings season, so there's an expectation that Q2 outlook for a lot of companies should be fairly decent. But as I said, I think it's the valuation which has attracted people back to this index and this market at the moment.
And where's the demand coming from? Is it Chinese investors or is it coming from offshore?
Asian markets in general are quite retail driven, so absolutely on the retail side and the domestic side there is that. But China's been, I don't want to use the word off limits, but it's been on the periphery, and due to the increasing geopolitical tensions, has been something a lot of fund managers have not been looking at, and some of them are actually forbidden due to their internal rules from adding to China positions. So I think we are seeing incremental signs of interest from foreign investors coming back. But yeah, I would say in fairness, this is still largely a domestically driven rally, which may well raise questions about the sustainability of that rally. But things are looking good at the moment, and with high expectations into the Q2 guidance, then in theory things could continue to evolve in a positive way.
Well, we're of course on the eve of hearing from another member of the Magnificent Seven as well. We're going to get some results from Apple in US trades early on. We're not expecting great news here, perhaps maybe sluggish earnings. Of course, China's been a little bit slow, but is generative AI on iPhones, is this the next big thing from Apple?
Well, Apple, as I think yourself and your viewers will appreciate, has been a bit behind the curve on that. That may well be to their advantage in the long term. There is some speculation in the market that they could be partnering with Google, and maybe using their technology to help narrow the gap on the AI side. The potential sort of advantage for them with that is they have foregone spending tens of billions on capex, unlike many of their other Mag 7 peers. But I think the core focus for Apple will remain the product business, and particularly iPhones, and specifically in China, where it's likely we're going to see ongoing weakness for the foreseeable future. So I think with the results that are coming overnight, the focus will most definitely be on the product area. And whilst I think my US colleagues think the revenue overall for the quarter could come a little bit ahead of expectations because of better pricing on some of their premium phones, the focus is all on the guidance really.
Just quickly, you mentioned product there. We're going to get our first look at sales with the Vision Pro. Are we expecting great things or just a
Being a cynical weather-beaten British person, I think is very interesting for your technophiles and your Apple files. Is it likely to evolve into a mainstream product in the long run? I think that's highly unlikely. Is it likely to be a major earnings driver for the business again in the long run? Again, I think that's highly unlikely. So great if you're an engineer or someone who loves tech, but this is not a mass market product in my view.
All right, Bloomberg Intelligence Senior Analyst Robert Lee. Still to come, Indian conglomerate Godrej gets split into two to maintain family harmony. We're going to to tell you what, who's getting what up next. This is Bloomberg.
Opportunities can be hard to find, like catching light on an problem. In uncertain times, it's tempting to retreat or simply wait and see. At CMU Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. At CMU Group, opportunity is everywhere.
We signed a 5-year deal because we see their ministry as a strategic partner. With the money that we've saved by moving the marine ministry, we're now able to work on some strategic projects that we've been wanting to do for years. The only advice I have for people is sign earlier.
Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Emery Ordern only on Bloomberg. Context changes everything.
All right, welcome back. You're watching the India Focus. What we're looking at here is shares in the various members of the Godrej family of companies. Of course, this is a 125-year-old diversified conglomerate. It's involved in all sorts of things from consumer goods, financial services, real estate. We saw a bit of a mixed bag at the moment. Property is weaker by 1.5%, but the rest of that bag of stocks doing pretty well. Now, a lot of change in the winds at Godrej. Here to walk us through the details of those changes is Bloomberg conglomerates reporter PR Sanjay. So, PR, we're hearing that this group is going to be split up to maintain family harmony. What's the business case behind doing this?
Well, you're right. It's a few points. One is like Godrej Group is one of the oldest conglomerates in the country, number one. And this is also a landmark deal for the Indian conglomerate landscape because this has been done very amicably, in a very friendship manner to maintain the harmony between groups, various companies, listed companies across. So to split, to give more clarity, the Godrej Group is split into two. One is Godrej Enterprises Group and Godrej Industries Group. And Godrej Industries Group will have 5 listed companies, including Godrej Consumer, Godrej Properties, Godrej Agrivet, etc., which will be led by Navi Godrej and Adi Godrej. And in the case of GEC, which is Godrej Enterprises Group, will be headed by Deira and Jamshid. And both companies, both groups can use Godrej brand name, which is one of the fabulous thing about this deal. And in the case of Adi Godrej, who was like a face of Godrej Group all the while, had stepped down from executive chairman position in 2021, and his son, Firozshah Godrej, will take over from Adi Godrej from 2026. So from what we are getting is like from all aspects, it is very amicable and very decent, settlement. And what we pick up, the reason behind the rationale behind this setup is one is to make their strategy very clear, and they don't want to spread too thin. They want to make best use of their management bandwidth, and they think that this will give more clarity for the goals, and we can expect more listing from the GEC group as well at this point of time, Paul.
It does sound an awful lot like sorting out some family politics. What do analysts think about this move?
So they're thinking that there's more clarity to the group because under Godrej Industries Group there are 5 listed companies and they are planning to list more companies as well. So with this clear kind of split, that too without any fight, they think that the management could be now get into more development areas. Like for example, Godrej Enterprises Group, they have
3,400 acres of land in Mumbai, prime land to develop. So one group can now focus on developing those prime properties in Mumbai. And Mumbai is like, when it comes to land, it's like really a price asset. So both companies and both listed units and all unlisted companies can now focus on their work, and they can develop, or they can make this conglomerate, both two different units, into greater heights. That's what analysts feel at this point of time.
All right, Bloomberg Conglomerates reporter PR Sanjay there. Thanks for joining us on the breakup of coverage. We have plenty more to come. This is Bloomberg.
Would you say race relations in the United States are much better than you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better. When I was so many people occupied areas, and I never thought I was even in. But I would have hoped that we would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations and so forth have become very scary. Some of the things that one reads about now remind me of growing up in Mississippi.
Here's some of the top finance stories that we're tracking today. DBS's first quarter profit rose as it continued to benefit from higher lending income and strong wealth management fees. Net income expanded 15% to $2.2 billion. That beat analyst expectations. CEO Piyush Gupta says the bank saw momentum across